Okay, we're continuing with the exam review for accounting, final exam review for accounting 3303. And this is a standard costing problem. So we want to know the materials price variance for the month and the materials quantity variance for the month. And they ask us to calculate at the time of purchase. So we purchased 1,000 board feet, and it cost us 13,300. This is the actual, and we want the flex based on input. Then what was 1,000, and if we go up here, the standard is 1360. So that would be 13,600. And so our materials price variance at the time of purchase is 300 favorable. Now, we have to actually do the amount used. And so that it's the same flex based on inputs, but now it's used. So now it's 400 times 1360. And that's 5,440. And now we need the standard. The actual output was 60 units times 6.3 feet from up here times 1360. 60 units times 6.3 times 13.6 will give us $5,140.80. That will give us $299.20 unfavorable, and that's all this problem asks for. Okay. The next one we've got, we need a production budget, and then we need a purchases budget. So we need the months of June. So this is A, the production budget. We need June, July, and August. And that's 20,000 for the sales, 25,000 for July, and 30,000 for August. We have no specific, let's see, the beginning inventory of June will be 2,500 units. So now we need ending finished goods is budgeted at 10% of current month sales, right? So that's a little bit different. We usually do of next month's sales, but this is of current month sales. So our ending inventory will be 2,000, giving us 22,000 here. It'll be 2,500 here, 27,500, and 3,000 here, 33,000. Then we need the beginning inventory. We're told that's 2,500 for the month of June, which gives us 19,500 500 is our production for June. Now we just slide these down. $25,500. All right, so that's part A, the production budget. And then it asks us to prepare the purchases budget for the PVC. So B, we are going to have June, July, and August again. All right, and then this is going to be our production is 19,500, 25, 500, and 30, 500. And let's see. We need 3 yards of material. So we need to multiply each of these times 3. $58,500. 76,500. And 91,500. So that's the amount of PVC tubing that we'll need for production. But then we need ending materials are budgeted at 10% of current month's production. So that'll be 5850. 7650. Again, this is unusual. We're usually looking at next month's, but this is current month's. So 9150. Add those up. That will be our total needs there. And then we need to subtract our beginning inventory and assume 16,000 feet. Oh, let's see. Did I get that wrong for material? I'm doing we need 8 feet of PVC. So I'm actually doing materials here. That's fine. So we've got 6,000 yards of materials. Then we slide this down. And $93,000 are purchases there. $78,300 there. And 58 there. Okay, so now we need to do the materials. I'm sorry, the PVC. So we're going to have June, July, and August again. So this is the PVC. And we need our production, which is 19,500. 19,500. 25, 500, and 30, 500. Now, PVC. Requires 8 feet of PVC tubing and 3 yards. So now we have to multiply this times 8. $156,000 feet. 204,000 feet. It's 244,000 feet. All right, then we need to add the ending inventory, and that's going to be the 10% of the materials for the month again. So 156, 204, and 244. Add those all up. And now we subtract off the beginning inventory. We had 16,000 feet in the beginning inventory. So we need 165,600 feet of PVC tubing. Now we just slide these down. And subtract them. 248,000 in August. And 208,800 in July. Okay. Well, okay. Now we're starting to repeat some of the things that we've done already. Falcon had net income last year of $1,500,000. They had total assets of $8,300,000. The board of directors has a required rate of return of 12%. The company has an opportunity to invest $500,000 in a project with an expected return of 15%. The board currently evaluates on ROI. Will management want to invest in this project? So to do that, we've got, this is 1,500,000 divided by 8,300,000. And so our current rate of return is 18.1%. So the answer is no, because the expected rate of return is 15%. That will lower all of it because the board currently evaluates managers on ROI. So that would lower my ROI and I would get a lower rating. So I don't want to do that. 2, would the board want to invest in this project? Absolutely. We have up here the expected return of 15%. Their required rate of return is 12%, so we're 3% over their required rate of return. So the board would want to do that. And this is when they talk about the agency problem, this is that. Would the board want to invest in this project? Yes, they would. How might the evaluation be restructured to ensure the board's interest and management's interest are aligned? Well, there are two things we could do here. We could reevaluate based on economic value added, or we could do it based on residual income. And so residual income looks at that 3% above times 500,000, and it would improve our residual income. So that would help that. Okay, this is one I think we did in class. And so this one is a little bit odd in that we've got 110% here and only 90% here. So I'm going to treat them as if they are the whole thing for the step method. It's not going to matter for the direct method. So A is the direct method. And so for P1 and P2, we're going to have 40 over 90. So the 90 comes from these two right here, 40 over 90 times 100,000. And that would be your would be 44,444. And for P2, we're going to have the 50 over 90. Again, here's the 50. The total is 90 times 100,000. And we get 55,055. I'm going to round that up to 6. That way they add up to 100,000. And we're good. So that is the direct method. And then B, on the step method, they ask us to allocate S1 first. So we're going to have S1, P1, P2. And so S1 is 20 over 110. 20, 40 is 60, and 50 is 110. So 20 over 110 times 100,000 equals 18,018. I'm going to round that up to 2. P1 is going to be 40 over 110. Right up here it was 40 over 90, but now it's 40 over 110 because we're including all three, times 100,000 equals 3636. Again, I'm going to round that up to 4. And finally, P2 is going to be 50 divided by 110 times 100,000. And we get 4545. Again, I'll round that up to 455. Okay, so now we add, for when we do S2, we're going to add the 80,000 to it. And that's going to be 98,182. So now we're back to essentially the direct method for that. Oh, I didn't finish the direct method above. Let me go back and do that. Here, let's finish this out. 98,000. So it's going to be 55 over 80 times 98,182 is 67,500, and 25 over 80 times 98,182 is going to equal 30,682. Add this and this together. We get 76,137. And for this one, we get 103,864. Okay, now I did not finish the direct method. I did the S1. I did not do S2. So we got 55 and 25 is 80. So 55 divided by 80 times 80,000 equals 55,000. 99,444. And then we'll have 25 divided by 80 times 80,000. Is going to be 25,000. Add those up. 8556. If you add that up, it comes to 180,000. 180,000. All right. Sorry for a little bit crowded there. This is one we did in class. All right. So that is part 5.